Today, we're diving into a detailed stock analysis of Centene Corporation, ticker symbol CNC, one of the leading players in the healthcare insurance space. Whether you're a long-term investor or just curious about the stock, we'll break down its financials, market position, risks, and whether it's a buy, hold, or sell in 2025. Let's get started. First, let's talk about what Centene Corporation does. Centene is a major healthcare company specializing in managed care services, primarily for government-sponsored programs like Medicaid and Medicare. They provide health plans to over 24 million members across the U.S., focusing on affordable healthcare for low-income and underserved populations. Their services include health insurance, behavioral health, and specialty services like vision and dental care. Centene operates in a highly regulated industry, but its focus on government contracts gives it a stable revenue stream, as these programs are less sensitive to economic downturns. The company has grown significantly through acquisitions, like its 2020 purchase of WellCare, which expanded its Medicare and Marketplace offerings. Why does this matter for investors? Centene's business model thrives on scale, government partnerships, and consistent demand for healthcare. But it's not without challenges, which we'll cover later. Let's move to the numbers. Let's dive into Centene's financials to see how it's performing. All data is based on the most recent filings as of Q2 2025, sourced from Centene's investor reports and market data available as of July 2025. Revenue and growth. Centene reported $153.8 billion in revenue for 2024, a 4% increase year-over-year from $147.9 billion in 2023. This growth is steady but slower than the 10% plus growth rates we saw pre-2023, largely due to the maturing Medicaid market and competitive pressures. The company's revenue comes primarily from premium and service revenues, with Medicaid accounting for about 60% of its total income. Profitability. Net income for 2024 was $2.8 billion, translating to a net profit margin of roughly 1.8%. This is lower than some competitors like United Health, which boasts margins around 5%. Centene's margins are tight because of the low-margin nature of government contracts. However, their adjusted earnings per share for 2024 came in at $7.45, beating analyst expectations of $7.30. Balance sheet. Centene's balance sheet shows $80.2 billion in total assets and $26.4 billion in total liabilities as of Q2 2025. Their debt-to-equity ratio is around 0.7, which is reasonable for the industry, indicating they're not overly leveraged. Cash and short-term investments stand at $18.1 billion, giving them flexibility for acquisitions or weathering regulatory changes. Cash flow. Free cash flow for 2024 was approximately $6.2 billion, down slightly from $6.8 billion in 2023 due to increased operational costs. This cash flow supports dividend payments and share buybacks, with Centene repurchasing $1.2 billion in shares last year. They don't pay a dividend, which might disappoint income-focused investors, but their buyback program signals confidence in future growth. Key metrics. Price-to-earnings ratio. CNC trades at a forward P/E of 11.2, compared to the industry average of 14.5, suggesting it's undervalued relative to peers. Price-to-sales ratio. At 0.3, it's one of the lowest in the healthcare sector, indicating potential value. Return on equity. 10.8%, solid but below top competitors like Humana at 15%. Overall, Centene's financials show steady revenue growth, modest profitability, and a strong balance sheet. But are these numbers enough to make it a buy? Let's look at the broader market and growth prospects. Centene operates in the managed care industry, competing with giants like United Health, Humana, and Elevance Health. Its niche in government-sponsored healthcare gives it a unique edge. Medicaid enrollment grew to 90 million Americans in 2024, driven by population growth and expanded eligibility in some states. Centene's 24 million members make it one of the largest Medicaid providers, giving it significant market share. Growth drivers. Medicaid expansion. Several states are considering expanding Medicaid under the Affordable Care Act, which could boost Centene's membership. For example, Recent proposals in states like Mississippi could add millions to Medicaid rolls. Medicare Advantage. Centene's WellCare acquisition strengthened its Medicare Advantage offerings, a fast-growing segment with 30 million enrollees nationwide in 2025. Aging population. The U.S. Census projects the 65-plus population will grow 20% by 2030, driving demand for Medicare plans. Acquisitions. Centene has a history of strategic acquisitions, and rumors suggest they're eyeing smaller regional insurers to expand in 2025. Competitive advantage. Centene's scale and expertise in navigating government contracts set it apart. Its technology investments, like AI-driven claims processing, have reduced administrative costs by 8% since 2022, improving efficiency. However, competitors like United Health have deeper pockets and broader networks, which could pressure Centene's margins. The healthcare sector is expected to grow at a 6% CAGR through 2030, and Centene is well-positioned to capture a chunk of that. But there are risks to consider, which we'll cover next. No stock analysis is complete without looking at the risks. Here are the key challenges facing Centene. Regulatory risk. Centene's revenue depends heavily on government contracts, which are subject to policy changes. For example, potential cuts to Medicaid funding or stricter reimbursement rates could hit profitability. The 2024 election cycle raised concerns about healthcare policy shifts, though no major changes have materialized as of mid-2025. Rising costs. Medical costs rose 7% in 2024 due to inflation and higher utilization rates post-COVID. Centene's medical loss ratio was 87.5% in Q2 2025, meaning 87.5 cents of every premium dollar went to medical expenses. If costs keep rising, margins could shrink further. Competition. Larger players like United Health and CVS Health are expanding into Medicaid and Medicare, intensifying pricing pressure. Execution risk. Acquisitions drive growth, but integrating new businesses can lead to operational hiccups. Centene's 2020 WellCare deal faced integration challenges that temporarily hurt margins. These risks don't make Centene a bad investment, but they're worth weighing against its growth potential. That's our deep dive into Centene Corporation. To recap, CNC offers strong fundamentals, a compelling valuation, and exposure to a growing healthcare market, but it comes with regulatory and competitive risks. If you're considering adding CNC to your portfolio, do your own research and consult a financial advisor. What do you think about Centene? Are you bullish or bearish? Drop your thoughts in the comments below. Thanks for watching, and we'll see you in the next one.